In business, the term inventory is used to describe the goods that a company has in its possession at any given time. For companies engaged in manufacturing activities, inventories are divided into raw materials, used to make other products, partially completed products, works in progress, and finished goods, ready for sale to the trade. Manufacturers sell their finished goods to wholesalers and retailers. These goods, purchased and held expressly for resale, are commonly known as merchandise inventory. For wholesalers and retailers, the primary source of revenue is from the sale of this merchandise. In terms of dollars, merchandise inventory is one of the largest and most important assets of a merchandising company. As an expense, the cost of goods sold is the largest deduction from sales in the determination of a company's profit, often larger than the total of operating and overhead expenses. To place a value on merchandise inventory, we must first know the quantity and the cost of goods remaining at the end of an operating period. Merchandise held for sale must be physically counted at least once a year. Many businesses take inventory on a quarterly or even monthly basis. This is known as a periodic inventory system because the physical inventory is counted periodically. Today, most companies use computers to track merchandise inventory on a continual or perpetual basis. This is known as a perpetual inventory system. For each merchandise category, the purchases made by the company are added to the inventory, whereas the sales to customers are subtracted. These balances are known as the book inventory of the items held for sale. As accurate as the perpetual system may be, it must be confirmed with an actual physical count at least once a year. One method of pricing inventory that actually matches the flow of costs to the flow of goods is known as the specific identification method. This method is feasible only when a variety of merchandise carried in stock and the volume of sales are relatively low, such as with automobiles and other expensive items. Each car, for example, has a specific vehicle identification number or serial number that makes the inventory validation accurate. A list of the vehicles in stock at any given time with their corresponding costs can be easily totaled to arrive at an inventory figure. The three most common cost flow assumptions or inventory pricing methods are as follows. 1. First in, first out, or FIFO. Cost flow is in the order in which the costs were incurred. 2. Last in, first out, or LIFO, where cost flow is in the reverse order in which the costs were incurred. And 3. Average cost, where our cost flow is an average of the costs incurred. The first in, first out, or FIFO method assumes that the items purchased first are the items first sold. The items in inventory at the end of the year are matched with the cost of the items of the same type that were most recently purchased. This method closely approximates the manner in which most businesses reduce their inventory, especially when merchandise is perishable or subject to frequent style or model changes. Essentially, this method involves taking physical inventory at the end of the year or accounting period and assigning cost in reverse order in which the purchases were received. To calculate the value of ending inventory using FIFO, Step 1. List the number of units on hand at the end of the year and their corresponding costs, starting with the ending balance and working backward through the incoming shipments. Step 2. Multiply the number of units by the corresponding cost per unit for each purpose. Step 3. Calculate the value of ending inventory by totaling the extensions from Step 2. To illustrate the application of the FIFO method of inventory pricing, as well as the other methods in this section, we'll use the following annual inventory data for 8x10 picture frames at Target. When physical inventory was taken at Target on December 31st, it was found that 700 remained in inventory. Using the FIFO method for inventory pricing, what is the dollar value of this ending inventory? Let's take a look at the solution strategy. With the assumption under FIFO that the inventory cost flow is made up of the most recent costs, the 700 picture frames in ending inventory would be as follows. Step 1. Set up a table listing the 700 frames with costs in reverse order of acquisition. So we have 200 units at $9 from the December 8th purchase, 300 units at $8 from the October 15th purchase, 200 units at $7 from the July 19th purchase to get us our 700 inventory on December 31st. Our solution strategy is continued with steps 2 and 3. We extend each purchase, multiplying the numbers of units by the cost per unit, and find the total of the extensions. So we have our 200 units at $9 for a total of $1,800, our 300 units at $8 for $2,400, and our 200 units at $7, which equals $1,400. This means our 700 units has an ending inventory value using FIFO of $5,600. The last in, first out method, illustrated here, assumes that the items purchased last are sold or removed from inventory first. The items in inventory at the end of the year are matched with the cost of the items of the same type that were purchased earliest. Therefore, items included in the ending inventory are considered to be those from the beginning inventory plus those acquired first from purchases. This method involves taking physical inventory at the end of the year or accounting period and assigning cost in the same order in which purchases were received. To calculate the value of ending inventory using LIFO, follow these steps. Step 1. List the number of units on hand at the end of the year and their corresponding costs, starting with beginning inventory and working forward through the incoming shipments. Step 2. Multiply the number of units by the corresponding cost per unit for each purchase. And step 3. Calculate the value of ending inventory by totaling the extensions from step 2. Let's go back to our target 8x10 frame inventory example. Let's calculate LIFO. On December 31st, 700 frames remained in inventory. Using the LIFO method of inventory pricing, what is the dollar value of this ending inventory? Here's the solution strategy. With the assumption under LIFO that the inventory cost flow is made up of the earliest costs, the 700 picture frames in ending inventory would be valued as follows. Step 1. Set up a table of the 700 frames with the cost in the order in which they were acquired. We had 400 units at $5 from the January 1st beginning inventory. We had 200 units at $6 from the April 9th purchase, and 100 units at $7 from the July 19th purchase. That gives us our 700 ending inventory on December 31st. Our solution strategy continues with steps 2 and 3. We extend each purchase, multiplying the number of units by the total cost per unit, and find the total cost of those extensions. So we have 400 units at $5 for a total of $2,000, 200 at $6 for $1,200, and 100 at $7 for $700. This means our December 31st ending inventory of 700 units using LIFO equals $3,900. The average cost method, also known as the weighted average method, assumes that the cost of each unit of inventory is the average cost of all goods available for sale during the accounting period. It is a weighted average because it takes into consideration not only the cost per unit in each purchase, but it also the number of units purchased at each total cost. To calculate the value of ending inventory using the average cost, follow these steps. Step 1. Calculate the average cost per unit by using the following formula. Average cost per unit equals cost of good available for sale divided by total units available for sale. Step 2. Calculate the value of ending inventory by multiplying the number of units in ending inventory by the average cost per unit. Ending inventory equals units in ending inventory times average cost per unit. Let's return once again to the example of 8x10 picture frame inventory at Target and kick the tires of calculating inventory using average cost. Using the average cost method of inventory pricing, what is the dollar value of the 700 frames on hand in ending inventory? Under the weighted average cost method, the 700 frames in ending inventory would be values as follows. Step 1. Calculate the average cost per unit. Remember, average cost per unit equals costs of good available for sale over total units available for sale, which means we have 10,900 over 1,600 for a total of $6.81. Step 2. Remember, ending inventory equals units in ending inventory times an average cost per unit. So ending inventory in this case equals 700 times $6.81 for a total of $4,767 in total ending inventory cost. In the previous section, we learned to calculate the value of ending inventory with several methods using a physical count at the end of an accounting year. Most companies, however, require inventory figures more frequently than once a year. Monthly and quarterly financial statements, for example, may be prepared with inventory estimates rather than expansive physical counts or perpetual inventory systems. In addition, when physical inventories are destroyed by fire or other disasters, estimates must be made for insurance. The two generally accepted methods for estimating the value of an inventory are the retail method and the gross profit method. For these methods to closely approximate the actual value of inventory, the markup rate for all items bought and sold by the company must be consistent. If they are not, the estimates should be calculated separately for each product category. For example, if a toy store gets 30% markup on tricycles and 50% on bicycles, these categories should be calculated separately. The retail method of inventory estimation is used by retail businesses of all types and sizes. To use this method, the company must have certain figures in its accounting records, including the following: A. Beginning inventory at a cost price and at retail or selling price, and B. Purchases during the period at a cost price and retail, and C. Net sales for the period. From these figures, the goods available for sale are determined at both cost and retail. We then calculate a ratio known as the cost to retail price ratio, or simply the cost ratio, by this formula. Cost ratio equals goods available for sale at cost divided by goods available for sale at retail. This ratio represents the cost of each dollar of retail sales. For example, if the cost ratio for a company is 0.6 or 60%, this means that 60 cents is the cost of each $1 of retail sales. To estimate the value of ending inventory by using the retail method, follow these steps. Step 1. List beginning inventory and purchases at both cost and retail. Step 2. Add purchases to beginning inventory to determine goods available for sale. Beginning inventory plus purchases equals goods available for sale. Step 3. Calculate the cost ratio. Cost ratio equals the goods available for sale at cost divided by the goods available for sale at retail. Step 4. Subtract net sales from goods available for sale at retail to get ending inventory at retail. Goods available for sale at retail minus net sales equals ending inventory at retail. Step 5. Convert ending inventory at retail to ending inventory at cost by multiplying the ending inventory at retail by the cost ratio. Ending inventory at cost equals ending inventory at retail times cost ratio. The gross profit or gross margin method uses a company's gross margin percent to estimate the ending inventory. This method assumes that a company maintains approximately the same gross margin from year to year. Inventories estimated in this manner are frequently used for interim reports and insurance claims. However, this method is not acceptable for inventory valuation on a company's financial statements. Remember that net sales comprises the cost of goods sold and gross margin. Net sales, or 100%, equals cost of goods sold percentage plus gross margin percentage. From this equation, we see that when gross margin percent is known, the cost of goods sold percent would be its complement because together they equal net sales, which is 100%. Cost of goods sold percent equals 100% minus gross margin percent. Knowing the cost of goods sold percent is the key to this calculation. We use this percent to find the cost of goods sold, which, when subtracted from the goods available for sale, gives us the estimated ending inventory. To estimate the value of ending inventory by using the gross profit method, follow these steps. Step 1. Calculate the goods available for sale. Beginning inventory plus net purchases equals goods available for sale. Step 2. Find the estimated cost of goods sold by multiplying net sales by the cost of goods sold percent. Estimated cost of goods sold equals net sales, 100% minus gross margin percent. Step 3. Calculate the estimated ending inventory by using the gross profit method. Follow these steps. Step 1. Calculate the goods available for sale. Beginning inventory plus net purchases equals goods available for sale. Step 2. Find the estimated cost of goods sold by multiplying net sales by the cost of goods sold percent. Estimated cost of goods sold equals net sales, 100% minus gross margin percent. Step 3. Calculate the estimate of ending inventory by subtracting the estimated cost of goods sold from the goods available for sale. Goods available for sale minus estimated cost of goods sold equals estimated ending inventory. Inventory turnover, or stock turnover, is the number of times during an operating period that the average dollars invested in merchandise inventory was theoretically sold out or turned over. Generally, the more expensive the item, the lower the turnover rate. Regardless of the method used to determine inventory turnover, the procedure always involves dividing some measure of sales volume by a measure of typical or average inventory. This average inventory is commonly found by adding the beginning and ending inventories of the operating period and dividing by 2. Average inventory equals beginning inventory plus ending inventory divided by 2.